picture this. You turn on the news, and global tensions are just boiling over.
Oh, absolutely everywhere.
Right. Wars are escalating in multiple theaters. Trade routes are under threat. Supply chains are fracturing. I mean, uncertainty is practically the only certainty left right now.
It's the defining feature of the market.
Exactly. And by all the old rules of finance, by, everything embedded into the algorithms of Wall Street over the last 40 years, gold should be skyrocketing right now.
It should be taken off.
It should be launching into the stratosphere as the ultimate hard money refuge. But you look at the terminal, and it is dropping. I mean, it's bleeding out.
Yeah, and it violates the deepest instincts of almost anyone who has ever traded a macro book.
Right. It feels wrong.
Totally. The muscle memory of the entire financial industry screams that in a geopolitical crisis, you buy gold, and yet the bid simply isn't there.
And it does not stop there either. Stock markets are having these violent, panicked intraday swings.
Oh, massive swings.
Yeah. And the Japanese yen, which, has historically been the ultimate safe harbor, the place where global capital goes to hide when the VIX spikes and things get scary.
Yeah.
Well, it should be surging.
But it's not.
No, it is tanking. It is breaking through multi-decade lows.
Which is incredible to watch.
It really is. Meanwhile, the U.S. dollar is just wrecking everything in its path. It is surging no matter what the underlying global economy is doing.
Up, down, panic, calm. It doesn't matter.
Right. The dollar just keeps climbing. It's acting like this giant vacuum cleaner, just sucking liquidity out of the rest of the world.
What we are witnessing is a total inversion of established financial gravity. I mean, the assets that are supposed to act as shock absorbers are becoming the shock amplifiers.
So does this mean the market is completely broken? Or is it possible that everything we thought we knew about money, risk, and safety was just a temporary illusion built on a foundation that, well, no longer exists?
It's definitely the latter. The market is functioning flawlessly under its current constraints. The machinery is not broken at all.
Really? Because it feels broken.
I know it does. But it is our outdated assumptions about how that machinery is supposed to operate that are failing us. You see, the correlations we worshipped were never laws of physics. They were just temporary behaviors dictated by a very specific era of monetary policy.
Okay, let's unpack this, because that is our exact mission for this deep dive.
I love it. Let's do it.
We are going to pull apart the raw mechanics of global finance. We are stepping past the surface-level price action to really understand why the old rules of gravity have suddenly inverted.
Because you have to look under the hood.
Exactly. We are looking at a total collapse of outdated market relationships, and we are going to discover the new structural environment that is driving absolutely everything right now.
And to do that, you have to strip away the emotional attachment to historical charts.
Which is hard for people to do.
It's incredibly hard. But correlation is not a signal. It is merely a byproduct of underlying liquidity conditions and yield differentials.
But people confuse the two constantly,
Yeah,
right?
constantly. They look at a chart from, say, 2010 to 2020. They see two lines moving in opposite directions, and they assume they are bound together by some invisible, permanent law of physics.
So if we want to understand why the rules are breaking, we first have to map out what those rules actually were, the classical playbook.
Right, the older regime.
Yeah, because for decades, institutional risk models, massive pension funds, and those ubiquitous 60-40 portfolios, they leaned on these historical correlations like they were the laws of thermodynamics.
The conventional macro playbook was built on a very specific, highly stable set of relationships. And these really calcified in the post-2008 era.
Okay, lay it out for us.
Think of it as a three-pillar framework. The first pillar was gold. Gold was the undisputed, non-sovereign safe haven.
The ultimate mattress to stuff your money under.
Exactly. When systemic risk elevated, or when geopolitical fear gripped the market, capital fled into gold because it carries zero counterparty risk.
Right, so crisis hits, fear spikes, gold catches a massive bid. That was just the foundational rule of risk mitigation.
Rule number one. Then the second pillar involved the Japanese yen.
The yen.
The yen operated as the ultimate risk-off currency mechanism, and this was primarily due to the mechanics of the carry trade.
Let's break that down for a second, because I think people hear carry trade and their eyes glaze over a bit.
Sure. So when global risk appetite was high, institutions borrowed cheaply in yen because Japan's interest rates were basically zero.
Free money, essentially.
Exactly. Practically free money. They borrow yen and they use it to fund higher yielding investments in, say, emerging markets or U.S. equities.
Okay, makes sense. But what happens when things go bad?
Right. When a shock hit the system, those leveraged bets were unwound. Institutions sold their risk assets and had to buy back the yen to cover their original loans.
And that massive wave of buying drives the currency's value up sharply during a panic.
Spot on. That was the yen's risk-off mechanism.
Okay, so that's two pillars. What about the dollar?
The dollar was the third pillar.
Yeah.
Historically, it had a sort of dual personality. We called it the smile theory.
The smile theory. I love that term.
Yeah, it was weak in risk-on environments when the global economy was booming. Capital was flowing outward into emerging markets to chase growth, so the dollar softened.
But during a crisis.
Oh, it was an absolute wrecking ball. It would surge purely due to the sudden, desperate demand for global liquidity. When credit markets froze, everyone scrambled for dollars just to clear their obligations.
Okay, so just to recap that three-pillar framework, you've got gold for non-sovereign safety, you've got the yen for risk-off deleveraging, and you've got the dollar for conditional crisis liquidity.
That was the gospel of asset management right there.
It really was. I mean, trillions of dollars in risk parity strategies were engineered around the assumption that these three assets would reliably offset equity drawdowns.
Trillions.
It sounds so neat and logical, you know?
Yeah.
You can see why entire careers and risk models were built on it.
Absolutely.
But those relationships weren't fundamental laws of nature. They were deeply dependent on the macro structure of the post-2008 world.
The ZRRP era.
It's exactly the era of zero interest rate policies, ZRRP, and quantitative easing.
Yeah, the post-Great Financial Crisis environment was an anomaly disguised as a new normal. We had highly predictable global liquidity cycles managed by central banks that were effectively moving in lockstep.
It was almost perfectly choreographed.
It really was. The Federal Reserve, the ECB, the Bank of Japan, they were all suppressing volatility. They were anchoring interest rates near or below zero and just flooding the financial plumbing with base money.
So it was an era of artificially infinite liquidity.
Artificial is the key word there.
Right. Central bank money printing heavily supported gold as a perceived long-term hedge against fiat debasement.
And at the same time, those ultra-low interest rates worldwide meant the Japanese yen's status as a funding currency went completely unchallenged.
Because nobody else was raising rates to compete.
Precisely. And because the Fed was pumping so much money into the offshore eurodollar system, it masked the structural scarcity of the dollar.
Under those incredibly specific synthetic conditions, the classical correlations appeared totally bulletproof.
Bulletproof, yeah. But the reliability of the playbook was entirely contingent on the central banks continuing to suppress the cost of capital.
Which they couldn't do forever.
No, of course not. The underlying drivers of those correlations were anchored by policy, not by organic market forces.
You know, I think about it like driving a car.
Okay, I like car analogies. Let's hear it.
It's like we drove for 15 years on a perfectly flat, straight, dry highway.
The QE highway.
Yeah. We built our entire driving strategy, our suspension, our tire choice, our braking distance, around those exact pristine conditions.
Makes sense.
We knew exactly how the car would handle if we turned the wheel slightly to the left.
Yeah.
We knew exactly how long it would take to stop.
Because the environment never really changed.
Exactly. But now the environment has changed. It's snowing, the road is iced over, we are navigating a steep downhill grade.
And the driver is losing their mind.
Completely panicked. Screaming and confused as to why slamming on the brakes is suddenly making the car spin out into the ditch instead of stopping smoothly.
That is a brilliant way to put it. The danger is that the flat highway behavior became embedded not just in algorithmic trading models, but in human intuition.
Like muscle memory.
Exactly. Muscle memory took over. Portfolio managers and everyday investors forgot the mechanical reasons why the rules worked in the first place. They mistook the artificial conditions of the road for the permanent laws of physics.
Which brings us right to the doorstep of the listener. I mean, why does this matter to the person commuting to work or reviewing their 401k right now?
It matters more than they realize.
Because whether you manage a massive sovereign wealth fund or you just have a basic target date retirement account, these outdated flat highway assumptions are baked into where your money is sitting today.
Deeply baked in.
Your portfolio is likely positioned for a sunny macroeconomic highway, but the blizzard has already arrived.
The breakdown of those assumptions isn't a future risk. I mean, it is actively happening on the tape right now.
Now, here's where it gets interesting. We are watching the real-time mechanical failure of both gold and the yen.
It's fascinating to watch.
Let's dig into the gold breakdown first. Under the classical playbook, a weekend filled with news about geopolitical escalation, missile strikes, and collapsing trade treaties. Well, that should result in a massive gap up for gold on Sunday
They
night.
should go parabolic.
Right. But we are seeing gold fail to hold those safe haven premiums. It flashes higher on the headline and then immediately bleeds out over the next 48 hours.
It just fades.
Why, I mean, if the world feels like it's falling apart, shouldn't institutional capital still want the ultimate hard asset? Why would anyone dump their gold when geopolitical tensions are at a multi-decade high?
To understand that, we have to look past the scary headlines and examine the actual plumbing of the financial system.
The plumbing.
Yes, the market is no longer pricing safety or neutrality as the dominant variable in asset allocation. It is pricing liquidity and, critically, opportunity cost based on real yields.
Okay, let's pause there. When we talk about real yields, we're talking about the risk-free interest rate minus the expected rate of inflation. So if the nominal treasury yield is, say, 5% and expected inflation is 2%, the real yield is roughly 3%.
And that 3% positive real yield completely rewrites the incentive structure for holding capital.
Because suddenly cash isn't trash anymore.
Exactly. Think about gold. Gold pays no dividend, it offers no coupon, it yields absolutely nothing.
It's just a rock.
It's a shiny rock, you hold it, you pay storage costs, and it just sits in a vault. Now, in a world of 0% interest rates, or negative real yields, which we had for much of the 2010s, the opportunity cost of holding gold is zero.
It costs you nothing to hide in a non-yielding asset.
Right. But the moment real yields go heavily positive, the math flips. It literally costs you money to hold a non-yielding rock.
Because you're missing out on that guaranteed 3% somewhere else.
Exactly. Capital is completely unsentimental. It does not care about your geopolitical fears. It cares about mathematics.
That's a hard pill for a lot of people to swallow.
It is. But capital prefers yield-bearing instruments over passive stores of value. Gold isn't inherently failing as a monetary metal. It is simply being outcompeted by U.S. sovereign debt that actually pays you a substantial risk-free premium to hold it.
So if I am an institutional manager and I can get a guaranteed risk-free real return of 2% or 3% on short-term U.S. Treasury bills, suddenly that allocation to gold looks incredibly expensive to maintain.
It's a drag on your performance.
No matter how scary the evening news is, my mandate is to generate return, and gold is dragging down my portfolio's yield.
Right. Now take that a step further into the mechanics of an actual crisis.
Okay.
When volatility spikes and liquidity becomes constrained across the global financial system, we see a fascinating and brutal phenomenon. When margin calls hit, you do not sell what you want to sell. You sell what you can sell.
Wow. That is a staggering realization. You don't sell what you want to sell. You sell what you can sell to raise cash.
In a heavily constrained liquidity environment, defensive assets are the first to get liquidated.
Give me an example of how that plays out.
Okay, let's say a hedge fund takes a massive hit on a highly illiquid private credit portfolio. Or they take a beating on emerging market debt.
Bad news.
Very bad. Now, they can't just easily offload those toxic assets to raise the cash they need to meet their margin calls. The spreads are too wide, the buyers are simply gone.
So they look at their book and say, what do we have that is highly liquid, that clears immediately, and that hasn't crashed yet?
And the answer is gold.
So they liquidate their gold holding.
Yes. Not because they have fundamentally lost faith in gold, but because they desperately need U.S. dollars to survive the clearinghouse requirements at the end of the day.
The mechanical need for dollar liquidity overrides the psychological desire for a safe haven.
Every single time.
Imagine being a retail trader looking at your screen during a geopolitical crisis.
Yeah.
You bought gold on Friday, hoping it would save your portfolio from the chaos.
You're waiting for the old rules to kick in.
Right. And instead, you just watch your position bleed out. You're sitting there thinking the market is totally irrational, not realizing that somewhere in London or New York, a massive institution is dumping paper gold just to generate enough dollar liquidity to keep their doors open.
The cold, hard math of margin and yield has completely overridden the emotion of fear.
And we see that exact same mechanical breakdown happening with the Japanese yen, but for slightly different structural reasons, right?
Yes, the yen is a different flavor of the same problem.
If gold is bleeding out because of real yields, that same force is basically suffocating the yen. Let's talk about the carry trade mechanics again. For years, the yen was the funding currency of the world.
Right. And the entire structural foundation of the yen carry trade relies on a persistent, manageable yield differential.
Remind us how that works in practice.
You borrow in Tokyo, where rates are near zero, and you deploy that capital into, say, U.S. corporate bonds or Mexican sovereign debt yielding 6% or 8%, and you pocket the spread.
Easy money.
Historically, yes. Now, when a massive shock hits the global system, the volatility causes institutions to panic, sell those risky high-yielding assets, and buy back the yen to close out their loans.
And that massive wave of repatriation buying is what caused the yen to historically spike during a crisis.
That's the classical playbook.
But right now, the VIX can spike, the stock market can gap down, and the yen just keeps weakening. The unwind isn't happening.
Because the traditional risk-off unwind mechanism depends on one absolutely critical condition.
Which is?
The cost of holding yen, or the perceived risk of the yield differential narrowing, must rise relative to the alternatives.
Right.
Right now, that condition is completely broken by central bank divergence.
Because the Bank of Japan is effectively trapped.
They are completely boxed in.
If they raise rates significantly to defend the yen, they risk blowing up their own domestic bond market, the GGBs, because they've promised to cap yields for so long.
Exactly. So they're stubbornly maintaining an accommodative, loose monetary policy while the U.S. Federal Reserve holds rates high.
So the spread between U.S. yields and Japanese yields is just simply too massive to ignore.
It's a chasm. Even in a period of high market stress, the penalty for holding yen is devastating. Funding in yen remains structurally cheap, while parking that money in U.S. dollars yields over 5%.
The math still explicitly tells traders to keep borrowing yen, shorting it, and buying dollars, regardless of the headlines.
Exactly. The carry trades are not being aggressively unwound because the structural yield asymmetry overrides the temporary spikes in volatility.
So capital continues to hemorrhage out of Japan.
It's bleeding out. The traditional risk-off mechanism, that automatic muscle memory of buying yen when stocks fall, is being completely crushed by the reality of central bank policy divergence.
But the real story is the U.S. dollar.
Oh, the dollar is the whole game.
It is the elephant in the room, the wrecking ball swinging through the global financial system.
It is the defining macroeconomic feature of the current structural regime.
Because the dollar isn't just rising during crises anymore like the old smile playbook dictated.
No, the smile is gone.
It is rising persistently across almost all conditions. Equities go up, the dollar goes up. Equities go down, the dollar goes up.
It's bulldozing foreign currencies, regardless of whether the market is in a state of greed or a state of panic.
This reflects a profound structural evolution in the role of the U.S. dollar. It has transitioned from being merely a conditional safe haven into an absolute juggernaut.
It really has. It is now operating simultaneously as both the world's premier liquidity asset and its premier yield asset.
A liquidity asset and a yield asset. I mean, that combination feels almost illegal in historical macro terms.
It breaks all the old models.
Usually you have to choose. You accept low yield in exchange for high liquidity and safety, or you take on illiquidity and risk to get high yield.
But the current macroeconomic environment has collapsed that trade-off. Well, the Federal Reserve's aggressive rate hikes have turned the U.S. dollar into a massive magnet for global capital. Because U.S. interest rates are so high relative to the rest of the developed world, dollar-denominated assets like treasuries or U.S. corporate credit offer superior risk-adjusted returns.
So that makes the dollar a premium yield asset.
Exactly. Capital flows to where it is treated best, and right now it is treated best in U.S. fixed income.
But at the exact same time, the offshore eurodollar market and the global trade system are still structurally dependent on U.S. dollar funding.
Completely dependent.
Oil is priced in dollars. Emerging market corporate debt is denominated in dollars. Global supply chains settle invoices in dollars.
The dollar is the indispensable plumbing of the global economy.
It's the water in the pipes.
Right. If an institution in Brazil wants to trade with an institution in South Korea, they don't use the real or the won. They use the U.S. dollar to clear the transaction.
And that inescapable utility makes it the ultimate liquidity asset.
So the global system is caught in a trap.
A very dangerous trap.
It is a systemic, structural vice grip. In times of extreme stress, the desperate demand for clearing liquidity strengthens the dollar. Institutions hoard dollars to survive.
But in times of economic stability and growth,
the demand for high yield strengthens the dollar as foreign capital chases U.S. returns.
wow.
In a panic, it goes up. In a calm, it goes up. The dollar is structurally bid across all environments because it is satisfying two entirely different massive sources of global demand at the exact same time.
If the dollar wins on heads and wins on tails, that dynamic has to be sucking the oxygen out of every other economy in the world.
It is suffocating them.
I mean, how does a developing nation survive when the U.S. is exporting this kind of financial pressure?
Honestly, it creates massive, compounding structural imbalances. When the Federal Reserve maintains restrictive monetary policy, keeping the terminal rate high, while other central banks are forced to cut rates to save their domestic economies, while the pressure continuously builds.
And that leads to what?
We enter what is known as the dollar doom loop.
The dollar doom loop. Walk me through the mechanics of that.
Okay, it starts with higher U.S. yields. Those higher yields attract foreign capital, causing the dollar to appreciate.
Got it.
Now, a stronger dollar makes it significantly more expensive for foreign nations to service their dollar-denominated debt.
Because their local currency is suddenly worth less against the dollar they owe.
Exactly. So to pay that debt, they have to sell their local currency and buy dollars, which weakens their currency further and strengthens the dollar even more.
Oh, man. It just feeds on itself.
It gets worse. Simultaneously, a stronger dollar suppresses global trade and commodity prices. That hurts emerging market revenues, which forces them to borrow even more.
It's a vicious cycle.
It is. The global system becomes deeply uncoordinated, with capital flowing relentlessly toward the U.S. at the expense of global growth.
Let's zoom out for a second. We've mapped out the failure of gold to act as a safe haven, the collapse of the yen's risk-off mechanics, and the sheer structural dominance of the dollar.
The three broken pillars.
Right. Let's clearly define the actual macroeconomic environment we are navigating right now. If the old flat highway era is dead, what does this new regime actually look like?
The current structural environment is built on 5 very harsh, unforgiving pillars.
Let's hear them.
First, structurally tight global liquidity. The era of quantitative easing and zero-cost capital is officially over. Central bank balance sheets are shrinking.
The easy money is gone.
Gone. Second, elevated real interest rates, meaning the cost of capital is positive after inflation.
You talked about how that crushes gold.
Exactly. Third, highly divergent central bank policies. The coordinated action of the post-2008 era is gone. Every nation is now fending for itself.
Every central bank for themselves.
Fourth, persistent, escalating geopolitical and supply chain instability.
Which feels like a daily reality now.
It is. And fifth, highly fragmented multipolar economic growth.
It is the literal inverse of the conditions that existed from 2009 to 2021.
Completely inverted. And the single dominant force in this new paradigm, the variable that dictates the pricing of every single asset class on Earth, is the cost and scarcity of U.S. dollar liquidity.
So if the old playbook of correlations is useless, we need a new framework. Let's talk about the hierarchy of forces that actually drives market pricing today.
This is crucial. To navigate this regime, you have to look at the forces driving the market sequentially, like a cascade.
Okay, what's at the top?
Sitting at the absolute top of the hierarchy, the number one force is liquidity conditions.
Specifically, U.S. dollar funding stress.
Exactly. U.S. dollar funding stress and balance sheet capacity. If dealer balance sheets are constrained and there are no dollars available in the repo market, literally nothing else matters. All assets will correlate to one, and they will sell off against the dollar.
The plumbing overrides everything.
Always.
What is number two?
Number two is yield differentials and real rates. Where can capital get the absolute best risk-adjusted return?
Which right now is the U.S.
Right. Then number three is capital flows, the physical, structural movement of that money across sovereign borders.
And what about sentiment? Market psychology, the fear and greed index that retail traders obsess over. Where does human emotion sit in this hierarchy?
It sits dead last at number 4.
Number 4.
It is the least reliable input in the current regime.
Okay, that is going to be incredibly controversial for a lot of technical traders to hear. Are you saying that market psychology doesn't drive price action anymore?
I'm saying it's subordinate to the mechanics.
That a massive global panic, like a true black swan event, won't trigger the usual safe haven buying just because of the Fed's interest rate policy.
Look, psychology absolutely exists, and it can drive short-term intraday volatility. You might see a headline spike.
Right.
But mathematics dictates the structural trend. You can be as panicked as you want. You can be sweating bullets watching the news as a geopolitical crisis unfolds. But if you do not have the dollar liquidity to cover your institutional margin calls, your psychological desire to buy a safe asset is completely irrelevant.
Because balance sheet realities brutally override emotional reactions.
Exactly the point. Markets are currently being driven entirely by cold, hard balance sheet constraints. This is the definition of liquidity vacuum dynamics.
Liquidity vacuum dynamics. Paint a picture of that for us.
I like to think of the global financial system right now as a high-stakes casino.
Yep.
The power goes out, the alarms start blaring, and the management announces they are locking the doors in exactly 5 minutes.
Chaos ensues, and the only way out is to cash in your chips.
But here's the catch. The cashier is only accepting one specific type of chip, the US dollar.
Wow.
It doesn't matter if you hold the most valuable European equity chips or the safest Japanese bond chips or even pristine gold chips.
They won't take them.
Nope. If you want to get out of the building, you have to sell everything you own at whatever price the market will give you just to acquire the dollar chips the cashier demands.
So in a tightening environment, liquidity becomes desperately scarce.
Right. Capital ruthlessly flows toward the most liquid instruments, and everything else is liquidated to fund it.
It's a vacuum. It just sucks the capital out of the periphery and pulls it right into the core.
And real yields sit at the absolute center of this transformation. As real yields rise, the gravitational pull of USD-denominated assets becomes inescapable.
Non-yielding assets are just discarded.
Exactly. Global capital reallocates toward the U.S., starving the rest of the world of funding.
Which feeds right back into that doom loop we discussed earlier.
It's all connected.
Higher yields lead to a stronger dollar. A stronger dollar tightens global liquidity. Tighter liquidity forces emerging markets to dump their reserves and buy more dollars to defend their currencies.
It is a self-reinforcing death spiral, and it has completely shattered the old correlations.
It is an algorithmic feedback loop that operates entirely independently of human sentiment.
Independent of sentiment, independent of historical charts.
So how do we survive this transition? Because if you are listening to this and your portfolio is still built on the assumption that bonds will save you when stocks crash or that gold will save you when the VIX spikes, you have to urgently rewire your brain.
You really do. The single most dangerous trap an investor can fall into right now is static thinking.
Static thinking.
The fatal mistake is looking at a terminal and saying, the market should behave this way.
Gold should be hitting $3,000 right now because of the war.
The yen should be strengthening because equities are selling off. The moment you catch yourself using the word should in this market, you have ceased to be an analyst and have become an ideologue.
You are projecting expectations based on a macroeconomic world that simply no longer exists.
Precisely.
It's like sitting down to play a high-stakes game of chess, right? But halfway through the match, half the pieces on the board suddenly start moving like checkers.
I love that. Yes.
If you stubbornly sit there screaming at your opponent that the knight should move in an L shape, you're just going to get swept off the board and lose your capital.
Because the board does not care about your historical rulebook.
You have to play the board as it actually is, in real time.
That analogy perfectly captures the reality of regime shifts. Correlations are inherently backward-looking. They only describe what did happen under a very specific previous set of constraints.
Right.
They contain zero predictive power about what must happen when the constraints change.
But human beings are pattern recognition machines.
Mm-hmm.
We hold on to those historical correlations like a life raft.
It's our nature.
When the correlations break, the immediate psychological defense mechanism is to assume it's just a temporary glitch, a momentary market distortion. The market is just irrational right now. It'll snap back.
And that is the tragic hubris of legacy asset management.
Oh man, they bleed for it.
They do. They see the correlation break, they bleed alpha for 6 months, and they think, the market is mispricing reality. I will just hold my position and wait for the mean reversion.
But what they fail to realize is that there is no mean reversion because the mean itself has moved.
Exactly. It is not a temporary distortion. It is a massive, blaring siren signaling deep, structural change. The entire global market is aggressively repricing under entirely new liquidity constraints.
If you blindly rely on the old correlations, you are just going to delay recognizing the regime shift.
To be the last to know.
You will position your money prematurely, you will buy the dip on assets that are structurally dying, and you will build this incredibly false sense of confidence right up until the margin call hits.
The mantra for this new environment is brutal but necessary. Those who fail to recognize the regime shift are not early to the trade. They are just wrong.
So we have to throw out the old playbook. We need a better framework. We have to completely replace correlation with regime analysis.
Regime analysis requires you to actually look under the hood. Instead of asking what historically happened to gold in the year 2011 during a crisis, you need to ask, What is the dominant macro force acting on the plumbing today?
Right.
Is the market currently constrained by liquidity? Is it pricing in a growth shock, or is it purely reacting to persistent inflation? Which specific constraint is binding the clearinghouses right now?
You have to focus entirely on incentives and mechanics, not historical relationships.
Yes.
Ask yourself, where can global capital earn the absolute highest risk-adjusted return right now? Where's the deepest, most accessible pool of liquidity?
Because those mechanical incentives, yield and liquidity, are the only things that determine the physical flows of capital.
The foundational takeaway here is that markets are deeply adaptive, evolutionary systems.
They constantly change.
Drivers shift. Regulatory constraints change. The participants themselves evolve. A strategy or correlation that worked beautifully and generated massive alpha in one regime, well, it becomes a toxic liability in another.
So true.
Look critically at your own assumptions right now. Look at your portfolio allocations. Are you sitting there holding a specific asset, enduring massive drawdowns, just waiting for it to rebound because it historically always does?
It's a dangerous game.
Remember that the market owes you absolutely nothing. It does not care about the sophisticated chart you drew based on back-tested data from 2012.
To synthesize all of this, the collapse of these traditional correlations across the FX, commodity, and equity markets is not an anomaly. It is not a temporary glitch in the matrix.
It's the new reality.
It is a full-blown systemic transition into a new macroeconomic era.
Gold is not fundamentally broken. The Japanese yen is not misbehaving. The US dollar is not acting irrationally.
No, the system itself has simply fundamentally changed its operating system.
The market never actually violates the rules of finance. It just ruthlessly rewrites them based on whatever macroeconomic force is dominant at the time.
And correlations that felt permanent to an entire generation of traders were just temporary reflections of an artificially suppressed environment. When that zero interest rate environment vanishes, the relationships vanish right alongside it.
The ultimate survivor in this new volatile financial landscape isn't the person with the most complex historical data models or the best memory for what happened in 2008.
Definitely not.
The survivor is the person who spots exactly when the old data is dead. You have to be willing to look at the board, realize the pieces are moving differently, swallow your pride, and adapt your strategy immediately.
Adaptability and a really deep understanding of market plumbing are the only ways to navigate a structural shift of this magnitude without being destroyed by it.
So as we wrap up this deep dive, I want to leave you with one final, provocative thought to mull over, something to really digest as you watch the chaotic price action on your screens this week.
I think I know where you're going with this.
We've established that the US dollar has become this inescapable financial black hole, acting simultaneously as the ultimate high-yield asset and the ultimate mandatory liquidity asset.
Right.
It's ruthlessly sucking capital and oxygen from every single corner of the globe. So ask yourself, what happens to the rest of the world, to emerging markets, to global trade, to foreign sovereign debt, if that liquidity vacuum never actually turns off?
It's terrifying to think about.
At what point does the sheer unstoppable strength of the US dollar become the very mechanism that fractures the global financial system completely?
It is the defining existential question of this new macro era.
Stay curious.
Yeah.
Keep aggressively questioning your assumptions. And we will catch you on the next Deep Dive.